The video today is based on VAT and how we'll be using VAT in our classes. So as you know, there are different rates for VAT on specific items. There's 14%, there's 0%, and there's exempt supplies. However, the video is just to illustrate how to account for VAT in your journal entries when you're purchasing inventory, which is example 1, and when you're selling inventory, which is example 2. So by example 1, I've said you purchase inventory on credit for 570 Rand. Okay, your journal entry, if you're using the perpetual method, would be you debit your inventory, you debit your VAT input, and you credit your accounts payable. Okay. The amount given to in example 1 is 570 Rand. That 570 Rand is to show that the amount you're actually going to have to pay your supplier is 570, which means by accounts payable, the amount will be 570 Rand. You now need to go determine what is the value of the inventory and what is the value of the VAT input. And you already know that the debits must equal to the credits, which is 570. So how do you determine that? The accounts payable, which is always the bigger amount, is equal to 114%, which means the 570 is 114%. The inventory will be 100%, and the VAT is the 14%. So inventory will say 100 over 114, and VAT will say 14 over 114. So 100 over 114 multiplied by 570 will give you the inventory value. And then 14 over 114 multiplied by 570 will give you the VAT value. So if you calculate that amount, inventory will be 500 and VAT will be 70. So 500 plus 70 gives you 570. That is when you are purchasing inventory. Now when you are selling inventory, the same rules apply. If you're selling inventory on credit for 798 Rand, the 798 Rand is the amount that the debtor has to pay you, because he has to pay you an amount including VAT. So your journal entry would be debit, accounts receivable, credit sales, and credit VAT output. And again now the sales will be the 100, the VAT output will be the 14. And accounts receivable is the 114, which is 798 Rand. So you're going to say 100 over 114 multiplied by 798 Rand. And you're going to say 14 over 114 multiplied by 798 Rand for the VAT output. So sales is 700 and VAT output is 98. Now, if you're using the perpetual method, it's very important to remember that you have a second journal entry for the sales. You debit your cost of sales and you credit your inventory. Very importantly, there is no VAT in this journal. Okay, VAT is recorded or calculated on a supply or a sale of something, of goods. So if you're selling your inventory, then the supply of goods is in the sales journal. This cost of sales and inventory journal is only to record the inventory which is decreasing in your business. So the cost of sales and inventory amount is given to you in the example 2 where I said the cost price was 400 Rand. So cost of sales and inventory stays at 400 Rand. There's no adjustment and there's no VAT.